Okay, so I'm looking at a number here that is, honestly, it's kind of insulting.
Insulting. How so?
It's from the Dalbar QAIB report. That's the quantitative analysis of investor behavior.
Right, the QAIB. I know the one.
And it spans this 30-year period, ending in 2015. So we all know the S&P 500 is the benchmark, right? It's the gold standard.
Absolutely.
Over that 30-year run, the S&P returned a very, very solid 10.35% a year.
That's a massive number. I mean, if you're compounding your money at over 10% for 3 decades, you are talking about life-changing wealth.
For sure.
That's the kind of return that turns a middle-class saver into, a multimillionaire.
Exactly. But here's the insulting part. The average equity mutual fund investor, the actual human being putting their money in,
Yeah.
they didn't get that 10.35%. They got 3.66%.
And that right there is the behavior gap in all its glory.
It's a gap of almost 6.7%. And before anyone thinks, oh, 6% isn't that much, let's just be really clear. That is missing out on more than half. Almost 2/3 of the potential growth. It's like buying a ticket for a rocket ship, getting scared at the launch pad, and then deciding to get off at the first rest stop.
It's a perfect analogy.
And look, if you want to stop setting your future wealth on fire like this, you need to subscribe to Money Mindset right now, and then listen closely to what the data actually says about winning at investing.
It really is a tragedy because when you contextualize that 3.66%, we aren't talking about money lost because the economy collapsed
No.
or because American business failed. That would imply the system broke. This is what Dalbar calls diminished returns.
Diminished returns.
This is hundreds of billions of dollars that just evaporated solely because of behavior. It's the cost of being a fearful, emotional human in a system that is, well, it's designed for cold, hard logic.
So that's our mission for this Deep Dives. We're going to unpack why smart people, doctors, engineers, people who are brilliant in their own fields, lose money, even during these huge bull markets. And more importantly, we are going to hand you the lazy solution that empirically just outperforms them.
We're going to walk through the lazy winner strategy.
We have a serious stack of sources today. We got Dalbar's behavioral analysis, the absolutely ruthless scorecard data from S&P Global's SPIVA reports. We've got SEC bulletins on the silent killer fees, and then the foundational arithmetic of legends like William Sharpe and John Bogle.
It's basically a masterclass in evidence-based investing.
So let's start with the culprit, the enemy in the mirror. We know the average investor lags the market by almost 7%.
Right.
Why?
Right.
The Dalbar study actually categorizes the causes. Is it just that people are, picking the wrong stocks, like they bought Enron or Blockbuster?
You'd think so, right? You'd assume it's a skill issue, but Dalbar breaks it down, and the number one cause of underperformance, and it's by pretty significant margin, is voluntary investor behavior.
Which sounds like a very polite academic way of saying user error.
It is the polite way of saying panic selling, exuberant buying, and the arrogance of trying to time the market.
Emotional stuff.
That specific behavior accounted for a huge chunk of that lost return. Fees were the second leading cause, which we'll definitely get to, but our own brains are the primary problem.
So it isn't that the market is beating us. We are beating ourselves.
Precisely. And we have to understand why before we can fix it. The core psychological trap here is that human beings are loss-averse. We're not risk-averse.
Okay, what's the distinction there?
Well, think about it in evolutionary terms. Like 50,000 years ago, avoiding a predator was infinitely more important than finding a slightly better berry bush.
Sure.
If you miss the berries, you're hungry for a few hours. If you miss the tiger, you're dead. So our brains just evolved to prioritize safety over optimization.
We are wired to survive, not to compound capital.
Exactly. And in modern financial terms, studies show we feel the pain of a loss about twice as intensely as we feel the joy of an equivalent gain.
Twice as much.
Yeah. So losing $1,000 feels terrible. It physically hurts. Gaining $1,000 feels nice. So when the market drops, that ancient part of your brain, the amygdala, just screams, "Danger, tiger!" And you want to run. You want to sell to stop the pain.
And I guess conversely, when the market is flying high, we feel safe.
Right. The herd is safe. So we all pile in. This creates the classic blunder. Buying high because it feels comfortable and selling low because it feels absolutely terrifying.
We're doing the exact opposite of what you're supposed to do.
The exact opposite of buy low, sell high.
The data on this is just wild. Dalbar looked at retention rates. So basically, how long does the average investor actually hold a mutual fund? Because we're always told, hold it for the long term.
Decades.
10, 20, 30 years.
The average retention rate is less than 4 years.
4 years. We're investing for retirement, which might be decades away, yet we're jumping ship before we even finish a single presidential term.
It's crazy. It's the result of that psychological pressure. A great example from the data, and this is a specific moment in time, is 2015. In January of that year, there was this tiny correction.
Okay.
The market dipped about 3%. It wasn't a crash, just a standard little blip. But investors panicked. They saw red on the screen, and they just pulled money out.
They saw the tigers.
They ran. But then in February, the market turned around and surged nearly 6%.
But the investors were sitting on the sidelines in cash.
Exactly. They locked in the loss in January, and then they missed the gain in February. By trying to avoid a tiny loss, they guaranteed a loss.
It reminds me of being in the grocery store checkout line. You know this feeling. You're in a line, you see the line next to you moving a little faster, so you switch.
Oh, yeah.
And as soon as you switch, that line stops because someone needs a price check, and your old line starts moving again.
Every single time. It's a law of the universe.
If you had just stood still, you'd be out the door.
Yeah.
But instead, you're just shuffling back and forth, wasting time and energy.
That's a perfect analogy for market timing. And the source material actually highlights 9 distinct behaviors that drive this checkout line shuffling. But 3 really stood out to me as the most destructive.
Let's hit them.
Okay, the first is herding. This is just doing what everyone else is doing simply because they're doing it.
Right.
If everyone is buying tech stocks or AI stocks, you feel unsafe not buying them, even if the valuations make absolutely no sense. It's the fear of being the only one not at the party.
SOMO.
Pure FOMO. The second one is recency bias. This is the assumption that whatever just happened is going to keep happening forever.
The market has been up for 3 years, therefore it will be up this year. Or the other way around, the market crashed yesterday, so it's going to crash again tomorrow.
It's like driving by only looking in the rearview mirror. You project the immediate past onto the infinite future. And the third one is narrow framing. That's making decisions without looking at the big picture. You look at one specific fund in your portfolio that's down, and you just panic. You fixate on that one red number, ignoring that your overall portfolio might be totally fine.
Yeah.
Or that the drop is just normal volatility for that asset class. You lose the forest for the trees.
It's fascinating that we are biologically hardwired to be bad at this. It's almost like the stock market was designed to punish human nature.
It really is.
But I want to pivot a little bit to the logic of the market itself. Because even if we control our emotions, we still have this idea that we can beat the market if we just try hard enough.
The alpha chasers.
Right. We think, I'm smart, I read the news, I can pick the winners. But there's a guy named William Sharpe, a Nobel laureate, who wrote this paper.
The Arithmetic of Active Management.
Yes. And he basically proves that beating the market is, well, mathematically impossible for the group as a whole.
This is one of those papers that is so simple, it's just devastating to the entire active management industry.
It really is.
He starts with a core axiom. The market consists of all the stocks. Therefore, the return of the entire market has to be the weighted average of the returns of all the investors in it.
Okay, let's walk through this slowly because it's pretty profound.
So imagine a giant pot of money. That's the entire stock market. Now just divide the investors into 2 groups. Passive investors, the indexers who just buy the whole pot, and active investors, the stock pickers who are trying to swap slices to get the best ones.
Okay, got it. 2 groups.
The passive investors, by definition, they hold a slice of everything. So they get the exact market return. If the market goes up 10%, their slice goes up 10%. They don't trade, they just hold.
That makes sense. They own the market.
So if the whole pot goes up 10% and the passive part of the pot goes up 10%, what must the active part of the pot do?
Mathematically, it has to go up 10% as well. It has to balance out.
Correct. Before you even think about fees, the average active dollar must equal the average passive dollar. It's just ironclad arithmetic. You cannot have the average active investor beating the market because they collectively are the market.
Okay, but you said it, before fees. And that's where the trap springs.
That is the clincher. Active management costs a lot of money. You have to pay the analysts with their PhDs, the Bloomberg terminals, the trading commissions, the marketing budgets.
The Super Bowl ads.
The Super Bowl ads. And passive management is cheap. It's just a computer script tracking a list.
Right.
So if the returns are the same before costs, But active has much higher costs.
Then the after-cost return of the average active manager has to be lower than the passive manager.
It's not an opinion. It's not a theory. It is just subtraction.
That really reframes the whole industry. It basically means investing is a zero-sum game.
John Bogle, the founder of Vanguard, he talks about this all the time in the little book of Common Sense Investing. He points out that trading is a zero-sum game relative to the market return. For you to beat the market by 1%, someone else has to underperform the market by 1%.
Because you're trading with each other. If I sell a stock at the peak, some other person bought it from me at the peak. I won, they lost.
Correct. But Bogle takes it a step further. He says it's a zero-sum game before costs. Once you factor in what he calls the croupier's take.
A house is cut.
The fees, the taxes, the bid-ask spreads, it becomes a loser's game. The total amount of money investors take home is less than the market return by exactly the amount of those costs.
So the house always wins. And the more you play, the more you trade, the more the house takes.
Precisely. Every time you trade, you're paying a toll. The less you pay in tolls, the more you keep.
But okay, that's the theory. That's the math on paper. Does the real-world data actually back this up?
It does.
Because I feel like every mutual fund commercial I see claims they beat their benchmark, rated 5 stars by Morningstar, ranked #1 in their category.
Marketing is a very powerful thing, but that is where the SPVIA scorecards come in. S&P indices versus active. They track this religiously, and the verdict is just, it's brutal.
Ah, brutal.
Over a 15-year period, there were no categories, not large cap, not mid cap, not small cap, not international, where the majority of active managers outperformed their benchmarks.
None. Wait, not even the smart money on Wall Street.
Zero. In the 2022 report that was mentioned in our sources, over 80% of U.S. equity managers failed to beat the S&P 500 over a 10-year period.
80%. Wow. Imagine if a doctor failed 80% of the time.
Yeah.
Or pilot. Ladies and gentlemen, we have a 20% chance of landing today. You would not get on that plane.
You would not, and it gets worse the longer you look. In the short term, say, 1 year active managers can get lucky. Maybe 35% or 40% beat the market.
Like a coin flip.
Basically a coin flip. But as you stretch that timeline out to 5, 10, 20 years, the percentage of winners just drops towards zero.
It seems impossible that an entire industry can fail this consistently. Is there a trick? I mean, how do they keep selling these funds if they keep failing?
There is a very sneaky trick the industry uses called survivorship bias. This is so crucial for listeners to understand because it just skews your perception of reality.
Okay, how does that work?
So the SPI data shows that over a 20-year period, nearly 64% of funds were either merged or liquidated. Basically, they did so poorly they were just shut down. They disappeared.
They got deleted.
Right. So if you pick up a finance magazine today and look at the top funds the decade, you are only looking at the survivors. You aren't seeing the thousands and thousands of funds that failed and lost people's money along the way.
It's like judging a marathon, but they remove everyone who collapsed or quit before the finish line from the final results.
Exactly.
Look, everyone finished. Everyone is a great runner. Well, no, they didn't. The people who passed out at mile 12 just aren't in the photo.
That's a perfect analogy. The data looks so much better for active managers than it really is because the losers are erased from history.
Okay, so I want to play devil's advocate for a second. We saw a
Okay.
really interesting discussion on Reddit about this.
Oh, yeah.
And the question was basically, does this apply everywhere? There's this idea that maybe in the US, the market is hyper efficient. Everyone knows everything about Apple and Amazon instantly.
Right. The information is out there.
But what about in India or in small cap stocks or emerging markets? Isn't there more inefficiency there for a smart manager to exploit?
It's a very common argument. The idea is that in inefficient markets, information isn't shared perfectly. So maybe a manager with, boots on the ground in Mumbai or Sao Paulo knows something the index doesn't. This is what they call seeking alpha.
Right. I know a guy who knows a guy who says this factory is booming.
And intuitively, it makes sense. But the SPIVA data covers international markets and small caps too. And the result? The majority of active managers still eventually lag the index.
Why, though? If the market is inefficient, shouldn't the smart pickers win?
Well, two big reasons. One, the costs are even higher in those markets.
Yeah.
Trading in emerging markets is expensive. Liquidity is lower. So the hurdle you have to jump over just to break even is higher. You have to beat the index by maybe 2 or 3% just to pay your own fees.
And the second reason?
Consistency is just incredibly hard. A manager might crush it for 3 years in Indian small caps, but then their style falls out of favor. Or worse, the fund gets successful, billions of dollars pour in, And now they're too big to trade nimbly. They basically become the market.
So it looks like skill in the short term is often just luck.
And the risk for you, the listener, is picking the wrong manager. As that Reddit discussion pointed out, you have to be lucky enough to pick the one fund that's going to outperform for the next 20 years out of thousands. That's a gamble on top of a gamble.
Let's go back to that cost issue, because I think people hear 1% fee and they just shrug. They think 1%, that's pennies. I tip 20% at dinner. Who cares about 1%?
This is the silent wealth destroyer. The SEC Investor Bulletin breaks this down with terrifying clarity. Let's just walk through the math. Imagine you invest $100,000 over 20 years.
Okay, $100.
And let's compare a 1% annual fee, which is pretty standard for active funds, versus a 0.25% fee, which is typical for a passive index fund.
And honestly, a lot of them are even cheaper now.
Way cheaper. Many are closer to 0.03%. But let's stick to the example. A difference of 0.75% sounds like nothing.
Yeah, tiny.
Over 20 years, assuming a 4% growth rate, that 1% fee costs the investor nearly $28,000.
Whoa. Wait, $28,000?
Yeah.
From that little sliver of a percentage.
Yes. And here is the kicker, the part that people always miss. It's not just the fee you paid, it's the lost growth on that money. Because that $28,000 wasn't in your account compounding, you missed out on another $12,000 in growth.
So you are paying the fee, and then you're paying the opportunity cost of the fee. You're losing twice.
Exactly. You're losing on both ends.
That is the price of a decent car or a major home renovation, just gone, because you chose a fund with a slightly nicer brochure.
And this ties back to the efficient market hypothesis, or EMH, which came up in our source material.
This is the academic theory behind all this.
Right. So the weak form of EMH suggests that all past price information is already included in the current price. This means technical analysis, looking for patterns in charts, head and shoulders, moving averages.
Squiggly lines.
The squiggly lines are essentially useless. They don't predict the future. And the semi-strong form says that all public information is priced in, earnings reports, news, rumors. If you read it in the Wall Street Journal or hear it on a podcast like this one, it's already too late. The market reacted milliseconds after it was released.
So if the market is a supercomputer processing millions of trades a second, you paying a guy in a suit to try and outsmart it is probably not a great bet.
The conclusion from EMH is really simple. If you can't beat them, join them. Just buy the index. Capture the return of capitalism itself rather than trying to outsmart all the other participants.
Okay, so the math is solid. The data is solid. The fees are destructive. So why do we still resist this? Why isn't everyone indexing? We saw a great piece from Hebden Consulting that dug into the psychology of this.
It really comes down to the illusion of control.
Oh.
Doing nothing, just buying an index fund and waiting 30 years feels incredibly passive. It feels like you aren't trying.
It feels like losing control. We're wired to think that effort equals results. If I work harder at the gym, I get stronger. If I study harder, I get better grades. So if I trade harder,
I should get better returns. That's the logic in almost every other area of life. But in investing, the opposite is true. It is one of the few areas in life where laziness is a virtue. The more you touch your portfolio, the worse it performs.
because of fees, taxes, and bad behavior.
Right. But trading feels like taking action. It scratches that itch to do something.
And media does not help.
Not at all. Financial news needs excitement.
Yeah.
They need the 5 stocks to buy in now. A headline that says, buy an index fund and wait 30 years is the most boring headline in history. It doesn't sell ads. It doesn't get clicks.
It doesn't keep you glued to the screen during a commercial break.
So they focus on the outliers. They interview the one guy who bet it all on a penny stock and became a millionaire. They fuel that FOMO, the fear of missing out. They never interview the 10,000 people who tried that exact same thing and lost their savings.
It creates a totally distorted reality. We think winning big is normal when statistically, it's a lottery ticket.
And, there is also a really nuanced point in the Dalbar data about systematic investors versus average investors that I think is worth touching on.
Oh, this was the chart that actually surprised me. It seemed to contradict the whole slow and steady advice.
It is a bit of an anomaly, for sure. Usually we say dollar cost averaging, putting money in systematically every month is the best way. But Dalbar showed that in the specific 20-year period from 1996 to 2015, the average investor who put a lump sum in at the start actually beat the systematic investor.
Wait, really?
Just slightly, 4.67% versus 3.99%.
So the lazy put it all in at one strategy actually beat the monthly contribution strategy.
In that specific window, yes. But the why is everything. Context is key. 1996 was the start of a massive historic bull market leading up to the dot-com bubble.
Right.
Putting all your money in at the start of a rocket ride is mathematically better than trickling it in.
Because if you trickle it in, you're buying at higher and higher prices as the market goes up. Your average cost goes up.
Exactly. However, and this is the big reality check, Delbar also looked at the period from 2009 to 2015. In that recovery period after the great financial crisis, the systematic investor pulled away. They doubled the money of the asset allocation investor.
Because the systematic investor just kept buying during the crash.
Yes. And more importantly, systematic investing removes the behavioral risk. Yes, lump sum wins if you have nerves of steel and perfect timing. But most people who lump sum in get scared when the market drops 30% and they sell at the bottom. Systematic investing forces you to be disciplined. It automates the buy low part of the equation. It basically saves you from yourself.
It automates the discipline so you don't have to rely on willpower.
Exactly.
So let's get actionable. We have painted the picture of the problem. We know the enemy is our own biology. We know the active managers are charging us to lose money. What is the solution? It brings us back to John Bogle,
the patron saint of common sense investing. His golden rule is so simple: stay the course.
Which is easy to say in a podcast studio, but really, really hard to do when your screen is just bright red.
It is, but look at the history. The Bogle Center transcript highlighted specific moments where selling would have been just catastrophic. Take March 2003. This was the aftermath of the tech crash and 9/11. The market had been down for 3 straight years.
It felt like the world was ending. I remember people saying stocks were just dead as an asset class.
If you sold then, you locked in massive losses right before a huge multi-year bull run. Or look at 2011.
I honestly don't even remember a crash in 2011.
Exactly, but the market dropped 19%. It was technically almost a bear market. Debt ceiling crisis, European debt crisis.
Yeah.
It was scary stuff. If you panicked and sold, you suffered a permanent loss of capital because you stayed out and you missed the recovery.
December 2018 is another one. The market dropped 19% in a month.
And of course, March 2020. The pandemic starts, the NBA cancels the season, the world shuts down, the market drops 34% in a few weeks.
That was terrifying. I remember looking at my account and feeling like it was just going to go to zero.
If you sold then, you cemented a 34% loss. If you just did nothing, just stood there, you captured the entire shocking recovery that followed. The market hit new highs just months later.
So stay the course isn't just a slogan. It's the difference between being broke and being wealthy.
It is the only strategy that guarantees you capture the market's long-term return. You have to be in the pool to get wet.
So for the listener who wants to turn off the noise and actually build wealth, what are the specific rules? Based on all these sources, what's the checklist?
I think it boils down to 4 actionable things. First, asset allocation. You have to decide your risk tolerance, how much in stocks, how much in bonds, based on your timeline, not your feelings.
Right.
If you need the money in 20 years, you can afford volatility. If you need it in 2 years, you absolutely cannot.
Okay, rule 2.
Diversify. Don't look for the needle in the haystack, just buy the whole haystack.
Bogle's famous quote.
Exactly. Buy a total market index fund. You own the winners, you own the losers, you get the market return. You eliminate the risk of a single company going bust and taking your retirement with it.
Rule 3.
Ignore the noise. Just turn off the financial news. CNBC, Bloomberg, the screaming headlines, they are designed to make you trade. And as we learned from Dalbar, trading usually just means losing money.
And finally,
rebalance. This is the mechanical way to force yourself to buy low, sell high.
how does that work in practice?
Let's say your target is 50% stocks and 50% bonds. Stocks have a great year and they go up. Now your portfolio is maybe 60% stocks. Rebalancing just means you sell that extra 10% of stocks, you're selling high, and you buy bonds, buying low, to get back to 50-50.
It removes the emotion and forces you to take profits.
It forces good behavior. It turns you into a contrarian without you having to be smart about it.
I love that. It's a system that protects you from yourself. Okay, as we wrap up, I want to leave the listeners with a thought. We all walk around thinking we are above average, right? We think we're above average drivers, above average friends, and definitely above average investors.
It's a real thing. It's called the illusory superiority bias.
But the data we've just gone through proves statistically that we are not. In fact, most of us are terrible investors precisely because we are human. So here is the question. Are you willing to be average?
That is the ultimate provocation. Are you willing to accept the average market return which, by the way, has historically compounded into massive wealth if it means you end up wealthier than 90% of the people who are trying to be special.
It's the great paradox of investing. Trying to be special makes you poor. Accepting you are average makes you rich.
And just think about that luck versus skill element we talked about. If you see a manager beat the market for 5 years, your brain immediately screams, skill.
Yeah, of course.
But if you flip a coin and it comes up heads 5 times in a row, is that skill?
No, it's just probability.
The data says active management is likely just a coin flip. Don't bet your retirement on a coin flip. Focus on what you can control. Focus on what you keep.
Focus on the fees. Focus on your behavior.
And just stand there.
Sometimes the hardest thing to do is nothing at all.
Exactly.
That's it for this deep dive. Go subscribe to Money Mindset, stop checking your portfolio every day, and we will see you next time.
Stay the course.